In this video, we'll break down the newest information about the global economy and the latest information about the dollar's debasement to the craters in consumer spending following the start of the bank crisis and everything in between. So it will have an impact on everyone, and of course that includes you, so you don't want to miss it. You see, a lot of people, they skim over the top. They read the headlines. They're not willing to actually invest just a few minutes a day to learn about what's happening. They love short form content. They love to just think that they're learning a lot, but they never really do. So we look at the details here, and I spend all that time to basically break this down for you to make it digestible. Now, right here, I wanted to begin by looking at what's happening with debt and, of course, what people are doing with that debt. And specifically, I'm talking about investors. It's no secret that the popularity of treasury bill investments have surged after the Federal Reserve has been increasing interest rates. But why would somebody want to buy a treasury bill instead of a stock? We're talking about debt here. Why would somebody buy that? Well, let's take a look at that now. Here we have it. Treasury bills popularity is booming after the Fed raised rates. Now, they've been doing this for over a year. And as they say in this article, essentially you can get a quote unquote guaranteed of 3%, 4%, and beyond, depending on what you're getting. So it looks attractive relative to stocks, where the stocks have been all over the place. They've been so volatile. But you can get this thing, and if you trust that the government's still going to be able to pay their bills, well, then they're going to pay you back. Maybe that's a 6-month that you bought, maybe it's a 2-year, 30-year, whatever the case may be. You're going to be able to get your money back plus a little bit of something. And so you compare it to what's going on with the stock market. The stock market is losing 5%, 10%, 20%, depending on where your money is. And so this is about risk parity. If you've read Ray Dalio's principal books, you know about this. Risk parity is essentially that you don't have all your eggs in one basket. And if you read, The Intelligent Investor, you would know about this as well. The classic 60-40 split, but we break it down into what Ray Dalio refers to as risk parity. Think of having, a time in which things are doing well, so your stocks are going up at the same time, with the consideration of bonds, let's say. Bonds are going to give you a guaranteed money back. They're going to give you your principal back. They're going to give you your cash back, but they're also going to give you a little bit on top of that. And so the point is, even if the stock market is going down, you're still going to get that back at some point as those debt instruments, that's what they would call them, bonds, treasury bills, whatever, when they mature, they're going to give you that. So it's going to pile on top. But, we need to assume that these things aren't going to go bankrupt. If it's a corporate bond, you're buying debt of a corporation, is that company still going to be around? Are they defaulting on their debt? As we've seen right now, companies are doing that. So if you held their debt, you're in big trouble. And the same with sovereign bonds, countries' bonds. If they don't pay back, then you're in trouble. But if you believe that either that company or, maybe it's Apple, or maybe you're looking at the US, well, you would make the assumption, okay, I think they're going to be able to pay back, therefore it's a worthwhile investment. So you get into that. That way, when times are tough and the stocks are coming down, you are still able to actually have some appreciation in your total portfolio. So maybe all your stocks dropped by 50%, but you also held some assets. Maybe that was cash flow producing real estate. Maybe that was some dividend stocks, and maybe that's bonds, let's say. So all of those had still brought in income. At the same time, your whole portfolio didn't go down as much. I hope that makes sense. And that's why bonds, like people just say, no. But if we just understand as a whole, well, then we could say, okay, well, maybe I don't want it, but I could understand it. So that's the point. And the next aspect here, what we're looking at is really important, okay? Because of course it's about the Federal Reserve. Now, central banks worldwide, they're grappling with this economic crisis. And this is going on with the banks, and some of it is reminiscent of what we saw back in 2008 for some people. It's not the housing crisis that we saw before. It is quite different, and rates have risen to levels that are considered too tight. Well, I want to talk about what's happening with the Fed and what they believe is going to happen. Apparently, they think growth is coming. So here it is. Fed's Bullard lifts his 2023 rate forecast on strong growth. Estimate is above the median, 5.1%, and near the high of the officials. St. Louis Fed chief said he assumes financial stress will ease. So if that's the case, that's a good thing if it does actually happen. And we need to pay attention to that. It's going to show us over the next few months whether they're going to be cutting interest rates as the markets expect, or whether they're going to remain tight. I think that's really, really key. And this is an article basically just saying the new Fed Now system, and which some people conflate with the central bank digital currency, the CBDC, that this isn't even fractional reserve banking. It's zero reserve banking. So the Federal Reserve wants to take this to the next level, and they want to do it soon, but they need a crisis for that to happen. And so the crisis is going on right now. Is it enough? Like, will enough banks start to fail that they'll have an excuse for this? Right now, too hard to tell, and too early certainly. But I really do want you to keep an eye out for what happens here as it relates to not just the Fed Now system, because the Fed Now system, when you're talking about B2B, business to business, or, country to country or whatever, it probably looks at it like an advancement. There's no real change in that respect. But central bank digital currency, that's a different story. Very different story, okay? We have the expansion of the balance sheet. So you could see what the Federal Reserve has been doing, and they've been doing a lot, let me tell you. And this is part of that. And we have noticed that they have been weaning off their balance sheet slightly. And in this particular week, they barely, just a few billion on mortgage-backed securities and the treasuries, just barely. And then other things have grown. And I talked about that in the previous video, but essentially we could see that they are expanding. They're not alone though, okay? The other central banks have been doing the same thing. That's I think I showed you last one, ECB, Bank of Japan, and others have begun to expand their balance sheets. The Swiss National Bank, they're all doing it. So we shouldn't look at this as something weird that the Fed is doing. It seems like we are going into another easing cycle. This is the BTFP, which is the fund that they've set up to backstop the banks, to make sure, no, we're not going to have a problem. We're going to stand right here. We're going to make sure it's all okay. The first week, I think the banks were kind of hesitant, and now that has increased quite a bit. Still low in compared to other resources and so on, but here it is. I believe that says $53 billion. You can look at what's happening in the bond market and see the volatility that corresponds to that, and I think it is quite extreme. Here it is right here, just showing you, this is called the MOVE index. Just think of the volatility of the bond market, okay? And it has gone significantly up higher, and we're not quite there yet, but almost to the levels of Lehman. So this is very important to watch it, because these type of signals, they're not going to come up on the radar for most people. But when we see that type of news, we know that, okay, there's a lot going on here. Even if we don't see it in the headlines, it's big. It really is. Okay? And, what I think is important here is that we realize the world economy has been thrown into turmoil in recent years. 2020 made things even worse. We need to look at what's happening with the root causes of the current economic crisis, and not what they're going to show you in the news, of course. The stuff that I break down is the reality. Central banks are contributing to this. They are the ones that are truly, in my opinion, at the center of it all. We need to look at the moral hazard, the dollar's debasement, and the fear of a global banking crisis by Deutsche Bank. I brought this up in previous videos, but it shows us that one thing after another really piles up, and that is very concerning, not just for investors, but for everybody. This was interesting. Small banks have much fewer, quote, shiftable securities. And you could see only 20% of small banks' assets are in US treasuries and agencies. So the point here is that they might have their deposits backstopped, but they don't have the liquidity. So that's really the problem with the smaller banks. That's the concern today. They do not have as much liquidity as the bigger banks. So should the banking industry run into trouble like it is now, the smaller banks are the ones with the big problems. Is that weird? Is that strange? But that's how it is. Okay, so the depositors, like I said, you might be okay unless they want to do a bail-in, which they are able to do. But this is just an interesting one. I wanted to pose that here as a question. What do you think will happen? Are the small banks the ones to be more concerned of? Or is it the big ones, the JPs, the Bank of Americas? What do you think? Let me know. Here we have recession indicators say that the Fed broke something. And you could see this in many different ways, but just one of those being the yield curve inversion. And what is all this stuff? The real technical, okay? No. Yield curve inversion, very, very simple. All you need to know for the purposes of this video is when you hear yield curve inversion, that basically means, think about it like this, if you were to buy something that's like a 6-month treasury, 6 months, and then versus a 30-year bond, you would think the 30-year bond would give you a better return than the 6-month one. Makes sense, right? Taking a more risk, 30 years, but what about when that reverses? That's the yield curve inversion. So you have it invert, and then when it comes back up to normal levels, that's when a recession comes through. And it's 100% accurate, going back and back and back. These things happen, recession follows. That's a simple matter of fact going on today. And we know that the Fed did break something by increasing interest rates, because this whole idea that you can keep easy money around for so long doesn't create problems. I mean, it's really a joke. But that's really what we get at. Net percentage of banks tightening lending standards. That's what they're showing as one example here. The financial conditions have been tightening. It's not just the interest rate, the Fed funds rate. There's so many different things. This was an interesting one showing us the US bank failures are among the largest in recent history. And it just compares them. Back in 2008, you had Washington Mutual, you had IndyMac, and now today, you've got the Silicon Valley Bank and the Signature Bank and all these others. Really amazing to see it visually laid out like we have here. And just like that, the tight money era is over. Tighten until something breaks. You've probably heard of that before, but I do think it is very apparent. You see, with what's happening today within the banking system, you are looking at, like, underneath it all, they are very concerned. People in the industry are extremely concerned, not just because their jobs are affected about this, but they don't know how to deal with this. They were really thinking, I showed you over and over again the different surveys, different analysts and so on, that said the Federal Reserve is not going to increase interest rates. Not going to happen. Then they did it once. They said, that's the end of that, it's over. And then it was twice, that's the end of that. And then 3, 4, over and over again. And they're in disbelief. And now they're saying, well, you got to cut interest rates, man. I can't handle this. And that's why everybody is saying, Jerome Powell, he's a bad guy. But when he was cutting interest rates, he was a good guy? It's nonsense. This is all about the moral hazard that we face today. And for a lot of people, they just can't grasp it, but it's right in front of our eyes. What they're doing with us right now is, in my opinion, quite extreme, because the entire world is going through a debasement of the currency. I'm going to talk about this here in a separate video, the reserve balances with the Federal Reserve banks, and that's how you are able to know the direction of the stock market. We're at an inflection point right now today. If you want to know exactly where it's going to go, don't go to these silly YouTubers out there. Don't go and try to find some stuff. I see this people searching. It's hilarious. You can go to Google and type in, stocks to buy or best stock or is Apple a good stock. People are literally Googling, or they're going into TikTok. They're going into, Facebook, Instagram, all these different things. and they're searching that. They're looking for the answers. When you don't have to do that, you can just use the money mirror method. And I know I've been highlighting that quite a bit, but for a lot of people, you know exactly what it is. We have to compare essentially the central bank assets compared to the stock market, mirror those together, you have your answer. Okay, I'm going to break that down fully in a video. I have been piecing it together. It's taken a little while, but I want it to be perfect for you when I do release that. That's how you know. That's exactly how you know what's going on. Look, enough talk. Are you interested in getting the video of the day direct to your email inbox? Yes. Go to themoneygps.com, scroll down to the bottom. I'm going to email you the video of the day directly to you. Why? Because the algorithm's not going to bring that to you in many cases. And then it's going to be right to you, and we have a way to converse. Themoneygps.com, scroll down. I'll see you there. Take care.